Hello again, David Moore, Equity Advantage with Robert Smith of Peregrine Private Capital, and let's talk a little bit about interest rates, okay? And I just want to start off by saying we've got a number of clients that sort of, I feel like our market was artificially stifled because people were like, oh, the rates are going to drop, the rates are going to drop. And we were first told they're going to have 3 or 4 drops in the first quarter. They haven't happened. Now they're talking about maybe in the fall. And I guess what I'd like to start off saying is I've been in the commercial real estate world in the business. Equity was started in 1991, so I've got a few years behind me here. But I would argue that interest rates probably aren't far from where they should be. We just had a whole bunch of people used to free money. And if you bought something that had a long-term mortgage on it, you're just fine and okay. But if you've got something that's got a loan renewal coming up, you might be in a bad spot with some of this stuff. But what do you see happening with the interest rate, Bob, and why do you feel that way?
Well, you're exactly right, David. The spiking rates have messed with all of our business from a volume and a velocity standpoint. That being said, like you, having been in the business now for 25 years, interest rates are cyclical. And as they go down, property values and transaction volume goes up. As they go up, property values and transaction volume usually goes down. And so we feel that we're probably pretty close to the top in terms of interest rates, cap rates. The 10-year Treasury appears to have peaked out in October, and albeit with little ups and downs, has been trending lower. And you could call that a leading indicator of where cap rates will probably go, because rising interest rates, the last 18 months have put a tremendous amount of pressure on cap rates, pushing them up, property values down, and simply making it more difficult to transact business. We think that's about done. And we're not the only one. BlackRock, which is the world's largest money manager with, I think, $9 trillion plus.
They got a little real estate, too.
They got a little real estate, too. They came out in a research piece not too long ago saying, quote, now is the time to buy CRE. And so when someone with $9 trillion and counting under management says that, markets tend to pay attention. So we're already starting to see a pickup in activity this first quarter that we didn't see in the last 2 quarters of 2023. Lots of apartment deals that had hung fire last year now appear to be on their way to getting done. So we think we're probably close to the top, and we'll likely see things trend down in the second half of the year. We were never overly optimistic, like a lot of the stock, like Wall Street and the stock mavens, in terms of early interest rate cuts. We always thought they would come sometime in the second half of 2024. And now with Fed Chairman Powell being on record not once but several times saying rate cuts are coming, he's going to have a very difficult time, I think, walking that back at this point, particularly given the fact that 2024 is an election year and the nominally independent Fed has to be experiencing lots and lots of pressure that way, because every president likes lower interest rates, and God knows Biden needs all the help he can get at this point. And so we think you're going to see rates trend down, albeit slowly, in the second half of the year, and we're already seeing transaction volume start to pick up, because I think a lot of those folks, obviously there's tons and tons and tons of cash on the sideline, dry powder, and a lot of those folks were hoping that the meltdown in office would spill over into other CRE types. and there might be fire sales in multifamily, other property types. That doesn't appear to be happening. And if this is the top in terms of cap rates, then you can make the argument that it's probably close to the bottom from a pricing standpoint, and that's probably going to push a lot of these people off the fence. Yeah. So that's what we see happening. Not that we have a
crystal
ball, nor does Chairman Powell call me in Portland, Oregon. But, I think it's a reasonable guess.
Well, the thing is, our volume, we're significantly off where we were a year and a half ago. I mean, just volume of transactions. What I sort of feel like's happening is the people who can do deals are doing deals, yeah. Right? And the bigger transactions, I sort of feel as though they're steaming along. It's just the lower, the regular consumer that's sort of stopped and for whatever reasons, maybe they're waiting for the rates to drop, or they just can't get the deal done right now, or we just had that free money that we had to overcome, and I think as soon as people accept the fact that, hey, this is probably where we're going to be for a while, and you've got an opportunity cost. I mean, it's you and I have talked about it in the past. I mean, with a 1031, or real estate's not considered a liquid asset, so you put it on the market, you sell it when you're happy when you sell it, right? And that real estate is a more stable asset, obviously, because of the lack of liquidity. You don't like a stock, sell, right? But it's sort of interesting when people come to us in the retirement side of our business and they're trying to figure out when they're going to go liquid on their portfolio so they can self-direct what they're doing. And so I don't want to do that because I've got a loss. And so to get them to understand, so look, whatever you have gave you the loss. You have the loss, whether you realize it or not, it's there. So you've got an opportunity cost. Is that thing that gave you the loss the best course forward, or are you better off shifting gears, going to the next thing? And that's one of those things that really always sort of blows my mind, because no, I can't realize that loss. It's there, okay? So is that thing the best course forward? And that's, I think, we've got to look at, everyone's got to look at, whether you're looking at the interest rates, it's a cost. If we're looking at an IRA-owned asset with leverage, you've got something called the unrelated business taxable income. I can't buy it because of, no, it's just another thing to factor into the return on investment there. So I sort of feel, I put it out there, if you're waiting around for this or that to happen, I mean, there's a cost to you sitting around waiting for this or that to happen. And those interest rates may go down, maybe they don't go down. But the real estate, typically, we're not seeing much of an erosion in value, and your buying power is decreasing. So ultimately, you're going sort of backwards, sitting on the fence, waiting for something that may or may not happen.
Couldn't agree with you more.
Yeah.
Okay. No.
It's a very interesting time, and I think there's lots of reasons for people to sort of justify in their mind to sit here and wait for something to happen, and you've really got to look at that opportunity cost. Is sort of my feeling.
Yeah, I think you have to be anticipatory, and that's what we've 2 years ago. We started rotating out of multifamily because we felt in many markets multifamily had become fully priced. Not that it will ever probably stop being a core institutional asset type, but it was very fully priced. And there was a likelihood that rents would start trending down and values would follow. And so we wanted to then take that opportunity, be anticipatory, and go on to the next property class that we thought would experience significant growth, which we did with senior housing. And due to the aging nature of the population. And again, that decision 2 years ago was recently validated by BlackRock in their real estate report, talking about going forward, CRE investors should structure their portfolios in such a manner that reflects the aging nature of the population, meaning more senior housing, more downsizing, that type of thing. So I think you're right. You can't simply sit and wait for things to happen to you. There are times in life when you have to happen on things. And I think we're probably at that juncture now where CRE investors need to get on with it and stop waiting for a return of the free money era and all that excessive speculation in price that occurred and move on to the next best thing.
Well said. Well said. Thank you, David Moore, Equity Vantage, and Robert Smith, Peregrine Private Capital. We'll be right back.